Hi, my name is Rafia Mehman and welcome to AI Talks, where we decode the hype, the hope, and the hard truths behind the AI revolution. In this AI talk, we are focusing on AI bubble, which means that we are going to analyze from their past to present to their future. And in that three domain, the question is AI really revolutionary or is going to be worse than the dot-com bubble? Or why the crazy valuation and capital flow same as 1999 is going on in the market. And the data shows is not just the hype but it's dangerous. And to understand everything in detail, let's just start it, and after the end of the video you will be able to understand in depth about the AI industry and what could be the things that you need to be careful while investing in the tech. Before we dive into it, what happened to the dot-com bubble, it's very important to understand what is bubble. Basically, a bubble has two stages, and according to me, it could be the third stage as well. The first one is the initiation or the origin of the state, and the second is the trigger point, and the third is the peak point when everything is done and dusted. So let's understand these three stages in the dot-com bubble and what is happening in the AI. So what happened to the dot-com bubble? Well, in 1997 till 1980, the scientists created real-time messaging technology, which is leading to the birth of the internet. That is a point of origination. So the second stage is the trigger stage. And with the launch of mzweb.com in 1993, which provided a graphical user interface and allowed people to read books on computer, was not only just a phase, but the peak stage happened after that the craziest valuation of the history has been seen at that time. And by adding the .com by the end of their business, they have the price multiple of 10x. And people without having a proper due diligence, they were just entering into the market and investing in it because they are believe that they over reliance on the technology. And what happened in 1999, the market realized that the business valuation at billions of dollars were neither viable nor scalable, and that was the time that the dot-com bubble was burst. So now let's just understand what happened with the AI bubble. Like in the starting stage of the 90s, there was some paper was published based on the calculations and machine computing powers. Later, by the launch of the open AI in the market has drastically changed. The people adapted, and it has been seen that the fastest adaptation by the humankind and the market changed. And now, right now, the craziest, the peak trigger point is going on in the market. We have seen Gemini AI, DeepSeek, ChatGPT, large models, and these market are captured by these of things. So, are we at the edge of the bubble? No, we are in the middle of the bubble, which means that any time that can be happen, and we are at the worst stage that can be collapse, and that can go up and then collapse. But because we know that according to the business cycle, there is always a boom and bust. So now let's just understand the red flags. The red flags that has been mentioned by the Professor Damodaran, and the Professor Damodaran mentions the NVIDIA valuation twice, before COVID and after COVID. Before COVID, he stated that there is a health growth, high profit margin of 71% due to unit economics, and there might be a decrease of 60% in margin forces due to the push by back on cost. And now in 2025, mentions in his report is that the AI industry is not a premium market anymore. And now this is shifting towards the customized market, which means that you can customize your based on your needs and based on your wants. And that's why 95% of the AI industry startups failed. Second red flag is the infinite money glitch, means a circular debt. NVIDIA invested in OpenAI, and OpenAI plays massive chips order back to NVIDIA. And not only that, but Microsoft invested in OpenAI, and OpenAI committed 10 billions of dollars to use Microsoft Azure. Amazon and Google both invested in Anthropic, which then use their respective cloud service. And there's an extreme disconnect between them by the valuation. OpenAI having a valuation of $500 billion, and but only $1 billion in revenue yet, and signaling a $10 billion of hardware exchange agreement with NVIDIA. And these transactions create a perception of explosion and inflate face spending versus revenue. And you will be shocked that why maintaining an infrastructure of the AI, they have to invest $500 billion. And the aggregate annual revenue is across around 15 to 20 billion dollar, and there is a deficit of it. So especially looking at the generative AI, while data center capex for 2025 is projected around $400 billion, estimated AI revenue early about 60 billion, which is giving a coverage ratio of 15%. And they are signing massive hardware deals such as 300 billion deal of agreement with Oracle for computing power. Some estimates suggest that the AI spending is $260 for every $1 in revenue. And this extreme spending rate often funded by shareholder equity or leading to share dilution or an overinflated valuation. Zero ROI paradox. It means that the 95% of startups are failed and only 5% has been succeed. So no return. So now let's just understand in the valuation and the systematic risk aspect. Bubble even worse than the dot-com. Do you think so? Let's just justify it. The concentration risk, the market concentration today is arguably more severe than in 2000. During the dot-com peak, the entire tech sector made up 30% of the S&P. And today the Magnificent 7, Max 7 alone account for 34% of the S&P 500. And NVIDIA, the dominant chip supplier, has been responsible for more than a third of S&P 500 gains this year and make up around 8% of the entire index. And this is not only just that, there is an extreme of the valuation going on. The Nasdaq 100 currently trades around 35 per times forward earning, which is half of the 70x peak in 2000, but still significantly higher than the historical 20x average. Company heavily exposed to the AI theme are trading far higher. NVIDIA to a price to earning ratio is of 56x. So now just understand what will happen if the bubble will burst. Well, a collapse in a massive concentrated players like NVIDIA will trigger a snowball effect, devastating the entire S&P 500 and risking a recession by crippling by spending of the top 10% of American who holds the 87% of stocks in the S&P 500. And history teaches us how to protect ourselves and find opportunities. So the first one would be prioritize your fundamentals and not go with your story, because we must employ critical thinking and look for the general undervalued companies. And the second would be avoiding circulatory risks, which means extremely cautious of companies that rely heavily on circular debts, funding deals, and as a revenue in synthetic. And when the music stops, cash flow would be the real. So the third thing you should be knowing is the diversify aggressively. Given the dangerous concentration in the Mag 7, portfolio diversification is absolute essential. And for those who are worried about the index weighting, consider funds that use equal weighted or fundamentally weighted formulas. And the last thing that you should be knowing is a poop. What is the meaning of poop? Panic lead to overselling, which create opportunity leading to profits. And downturns, when they occurred, offer deep value for savvy investors willing to buy high quality assets as a discount, just as Amazon survived the dot-com crash to become a market leader. So now AI technology is revolutionary, but the capital flowing into is not. We must stay vigilant, keep cash reserves, and remember the lesson of every bubble. The technology survive, but the highly leveraged, unprofitable companies built on the hype are not. So that's all from my side. And still, if you have any questions, comment down and don't forget to subscribe.